Something happened on December 1st, 2025 that most people completely missed. The Federal Reserve quietly ended quantitative tightening. And I know what you're thinking. That sounds like bureaucratic nonsense that doesn't affect your life. Here's the thing though. This decision is going to reshape how your money works over the next few years. Your savings account, your mortgage rate. The price of literally everything you buy. And the wild part is, this isn't even the first time they've pulled this move. Back in 2020, they did something similar. And if you didn't have money invested in the market, you got absolutely crushed. Not because you did anything wrong, because the system is designed that way. So in this video, I'm going to break down exactly what the Fed just did, why it matters to your actual wallet, and more importantly, what you need to do right now to avoid getting left behind again. Because the last time this happened, we saw the single largest wealth transfer in modern American history. And it's about to happen again. Here's what I want you to understand. The Federal Reserve doesn't work for you. They work for the system. And the system has a very specific playbook. When the economy looks shaky, they flood it with money. When inflation gets out of control, they try to suck that money back out. What they stopped doing on December 1st was that second part. For the past 3 years, they've been shrinking their balance sheet, trying to fight inflation by essentially deleting money from existence. Now, they've hit pause. And the reason this matters is because of what comes next. Before I explain what's coming, you need to understand the basic game. Think of the economy like a giant bathtub. The Fed controls the faucet. When they want the economy to grow, they turn the faucet on. Money pours in. Interest rates drop. Suddenly, it's cheaper to borrow money, so businesses expand, people buy houses, the stock market goes up. Everyone feels richer. But here's the problem. If you leave the faucet running too long, the bathtub overflows. That overflow is inflation. Your groceries cost more, your rent goes up, gas prices spike. The money in your savings account buys less and less stuff, even though the number stays the same. So what does the Fed do? They try to drain the tub. They stop adding new water and they let some of it evaporate. That's quantitative tightening. They stop buying bonds, they let their old investments expire, and money effectively disappears from the system. This makes borrowing more expensive, which slows down spending, which theoretically brings inflation back down. That's what they've been doing since early 2022. Now, here's where it gets interesting. On December 1st, they announced they're done draining the tub. The official reason? Inflation has cooled from 9% down to around 3%. Mission accomplished, right? Well, not exactly. Because there are two other reasons they're not advertising as loudly. First, bank reserves. That's basically the amount of cash sitting in the banking system. And it was getting dangerously low. Imagine walking into your bank and they tell you, sorry, we don't have enough money to give you right now. That's the nightmare scenario they're trying to avoid. Second, the job market is softening. Unemployment is creeping up. Companies are slowing down hiring. And the Fed's thinking is, if we keep money tight, this is going to get worse. So they're backing off. But now you might be thinking, okay, so they stopped tightening. That doesn't mean they're going to start flooding the system again. And technically, you're right. Stopping quantitative tightening is not the same as starting quantitative easing. Except here's what nobody's telling you. They might not call it quantitative easing, but they're absolutely opening the faucet again, just with a different name. On December 11th, just 10 days after stopping QT, the Fed announced something called Reserve Management Purchases, RMP for short. In plain English, they're going to start buying short-term treasury bills again. Now, the Fed is very careful to say this is not QE. It's just to maintain liquidity in the system. But here's the thing. When the Fed buys treasury bills, they create new money to do it. That money enters the financial system. It expands their balance sheet. It has the exact same effect as quantitative easing, just with a technicality attached. It's like saying, I'm not eating dessert, I'm just having a small sweet treat after dinner. Call it whatever you want, buddy. You're still eating cake. So let me paint you a picture of what happened the last time they did this. Because this is the part that should genuinely concern you. In early 2020, Right as the pandemic hit, the Fed owned about $4.2 trillion in assets. Within 2 years, they had ballooned that to $9 trillion. They printed nearly $5 trillion and used it to buy bonds. The goal was to keep the economy from collapsing. And in some ways, it worked. The stock market recovered, housing prices shot up, businesses got cheap loans and kept operating. But here's the kicker. The benefits were not distributed equally, not even close. If you owned assets, you got rich. If you didn't, you got crushed. Let me show you the math. In 2021, house prices increased 13%. The next year, another 18%. The S&P 500, which is basically the stock market, jumped 18% in 2020 and another 28% in 2021. If you owned a house or had money in the stock market, your net worth exploded. But if you were just working a regular job, saving cash, maybe renting, here's what happened to you. Inflation went from basically 0 to 9%. Your rent went up, your groceries doubled, gas hit $5 a gallon in some places, and your salary? The Bureau of Labor Statistics reported that real average weekly earnings fell about 3% between early 2021 and early 2022. You were making less money in real terms, and everything costs more. That's the K-shaped recovery. Rich people's line goes up, everyone else's line goes down. Now, this wasn't an accident. It's how the system works. When the Fed lowers interest rates and pumps money into the economy, asset prices go up, stocks go up, real estate goes up, bonds go up. But wages? Wages are slow. They lag. By the time your boss gives you a raise to keep up with inflation, prices have already run away from you. And the Fed knows this. They just don't care. Because their job is not to make you rich. Their job is to stabilize the system. And in their mind, the system is the big banks, the big corporations, the financial markets. You're just a side effect. So what did they do when inflation hit 9% and people started losing their minds? They panicked and reversed course. In 2022, they started quantitative tightening. They stopped buying bonds. They let their balance sheet shrink from $9 trillion down to about $6.5 trillion by the end of 2025. They also hiked interest rates aggressively. The goal was to cool down inflation by making borrowing more expensive. And it worked. Sort of. Inflation came down, but it also meant the economy started slowing. The job market softened. The housing market stalled. The stock market got volatile. And now, here we are. They've stopped tightening. They've started this new reserve management purchase program. And if you read between the lines, they're getting ready to open the faucet again. Now, here's the problem. Once they start, it's really hard to stop because the entire system is built on cheap money. Corporations are addicted to low interest rates. The housing market depends on affordable mortgages. The stock market goes up when borrowing is cheap. The second the Fed tries to tighten, everything starts to break. So they loosen again, and every time they loosen, inflation creeps back. And every time inflation creeps back, people who don't own assets get poorer. Let me give you a concrete example. Let's say you have $50,000 in a savings account right now. Your bank is probably paying you somewhere around 3% interest if you're lucky. So you're earning about $1,500 a year. Sounds okay, right? Except if inflation goes back up to 4 or 5%, which is very possible if the Fed keeps loosening, your $50,000 is losing value faster than it's growing. You're earning $1,500 in interest, but losing $2,000 or more in purchasing power. You're going backwards. Meanwhile, someone who took that same $50,000 and put it in an S&P 500 index fund, over the long term, they're averaging 7 to 10% returns. Even in a volatile year, they're keeping pace with or beating inflation. That's the difference. One person is building wealth, the other is slowly getting poorer, and they don't even realize it. Now, you might be asking yourself, why doesn't the Fed just stop messing with everything and let the market work itself out? And that's a fair question. The answer is they can't. Because the entire economy is now so dependent on Fed intervention that any attempt to step back causes a crisis. We saw this in 2018. The Fed tried to shrink their balance sheet, and raise rates, and the stock market had a meltdown. They immediately reversed course. The same thing happened in 2022. They tightened too fast, and suddenly banks started failing. Silicon Valley Bank collapsed. Signature Bank collapsed. The Fed had to step in and backstop the whole system. So now they're trapped. They have to keep intervening. And every intervention creates new distortions. And those distortions hurt the people who don't understand the game. Here's the other thing nobody talks about. The Fed is supposed to be independent. They're supposed to make decisions based on economic data, not political pressure. But in reality, they're not independent at all. Jerome Powell's term as Fed chair ends in May 2026. And Donald Trump has made it very clear he wants someone in that role who will do what he says, specifically someone who will cut interest rates aggressively. Trump loves low rates because low rates make the stock market go up, and the stock market is his scoreboard. He doesn't care if it causes inflation. He doesn't care if it hurts savers. He cares about the headline number. And once he appoints a new Fed chair who's willing to play ball, you can bet rates are going lower. Now, to be fair, it's not just the Fed chair who makes decisions. There's a whole committee of regional bank presidents who vote on policy. But the chair has enormous influence. And if Trump gets his guy in there, the pressure to cut rates is going to be intense, which means more money printing, more asset price inflation, more of the same cycle that's been crushing regular people for the past 15 years. So let's talk about what this means for you, because that's what actually matters. I see three major implications. First, inflation is probably coming back. Maybe not 9% like 2022, but higher than it is now. When interest rates fall, borrowing gets cheaper. When borrowing gets cheaper, people and businesses spend more. When spending goes up, prices go up. It's basic supply and demand. So expect your rent, your groceries, your gas, all of it to get more expensive over the next couple of years. Second, your savings account is going to lose value faster. If inflation is running at 4% and your savings account pays 3%, you're losing 1% per year in real terms. Over a decade, that adds up to a massive loss in purchasing power. And third, this is the big one. If you're not invested in assets, you're going to fall further behind. Because the people who own stocks, real estate, businesses, they're going to see their net worth increase. Not because they're smarter or work harder, because the Fed is inflating asset prices. That's just how the system works. Now, I'm not saying this to scare you. I'm saying this because I want you to understand the game. The Fed is not your friend. They're not trying to make you rich. They're trying to keep the system stable. And the way they do that is by making sure asset prices keep going up, which is great if you own assets and terrible if you don't. So the question is, what are you going to do about it? Here's what I think most people should do. Start investing. I don't care if it's $10 a week or 1,000. The point is to get your money out of cash and into assets that will grow faster than inflation. For most people, that means index funds. Low cost, diversified, long-term. You're not trying to beat the market. You're trying to match it. Because matching the market means 7 to 10% returns over time. And that's enough to build real wealth if you're consistent. The alternative is to sit in cash and watch inflation eat away at your purchasing power year after year, which is exactly what happened to millions of people during the last cycle. Now, I know some of you are thinking, but the market is risky. I could lose money. And yeah, you could. If you buy high and sell low, if you panic during a downtron, if you try to time the market, you're probably going to lose. But if you invest consistently, ignore the noise, and hold for the long term, history says you're going to do fine. The S&P 500 has never had a negative return over any 20-year period, ever. That's not a guarantee of future performance, but it's a pretty strong track record. Here's the thing that frustrates me. None of this is complicated. The strategy is simple. Spend less than you earn. Invest the difference in low-cost index funds. Hold for decades. Don't panic. That's it. But most people don't do it. Why? Because they don't understand the game. They think saving cash is safe. They think investing is gambling. They think if they just work hard and get raises, they'll be fine. And meanwhile, the Fed is quietly rigging the game against them. Not because they're evil, because that's how the system works. Let me tell you about a guy I know. We'll call him Dave. Dave is 42. He's got a decent job, makes about $80,000 a year. He's been saving diligently for the past 10 years. He's got about $60,000 in a savings account. He's proud of it. He thinks he's being responsible. But here's the problem. In 2020, that $60,000 could buy a lot more than it can today. His rent has gone up 30%. His groceries have doubled. His car insurance is through the roof. And his savings account is paying him 3% interest. So he's earning $1,800 a year while losing probably $3,000 or $4,000 in purchasing power. He's getting poorer every single year, and he doesn't even know it. Meanwhile, his coworker Sarah put $60,000 into an S&P 500 index fund back in 2020. It's now worth about $90,000. She's up 50%, not because she's smarter, because she understood the game. Now, I'm not saying you should take all your money out of savings and dump it into the stock market tomorrow. You need an emergency fund. You need liquidity. But if you've got money sitting in a savings account that you're not going to touch for 5 or 10 years and you're not investing it, you're making a mistake. A big one. Because inflation is a silent tax. It doesn't show up on your bank statement. You don't get a bill, but it's eating away at your wealth every single day. And the Fed just signaled they're about to make it worse. Here's the other thing. You don't need to be rich to start investing. You don't need $10,000 or even $1,000. You can open a brokerage account with most platforms and start investing with $10. The barrier to entry is basically zero. The only thing stopping you is knowledge and momentum. And that's fixable. You can learn this stuff. It's not rocket science. You don't need to understand options or derivatives or short selling. You just need to understand index funds, compound interest, and time horizon. That's it. So let's talk about what's probably going to happen over the next 12 to 18 months. This is my read based on what I'm seeing. First, the Fed is going to keep cutting interest rates. They already cut 3 times in late 2025. They said they're pausing, but I don't believe them. The economic data is softening. Unemployment is ticking up. And once Trump gets his new Fed chair in place, the pressure to cut is going to be enormous. So rates are going lower. Second, they're going to expand this reserve management purchase program. They'll call it something technical and boring, but the effect is going to be the same as QE. They're going to pump more money into the system. Third, asset prices are going to go up. Stocks, real estate, maybe even crypto. Because when the Fed opens the faucet, money has to go somewhere, and it goes into assets. And fourth, inflation is going to creep back up, maybe not to 9%, but 4, 5, maybe 6%? Totally possible, which means everything is going to get more expensive. And if your income doesn't keep up, you're going to feel poorer, because you will be poorer. Now, here's the part that really gets me. The Fed knows all this. They know that their policies create wealth inequality. They know that asset owners benefit and wage earners get crushed. They've seen the data, they've read the studies, and they do it anyway. Why? Because their mandate is not to make the economy fair, it's to keep it stable. And in their mind, stable means keeping asset prices from collapsing, even if that means regular people get squeezed. It's not a conspiracy, it's just incentives. The Fed is run by people who come from Wall Street and go back to Wall Street. Their entire worldview is shaped by financial markets. So when they make decisions, they prioritize financial stability over economic fairness. And the result is a system that works great for people with capital and terribly for people without it. I want to show you one more thing. Let's say you're 35 years old right now. You've got 30 years until retirement, and you've got $10,000 to invest. If you put that money in a savings account earning 3%, in 30 years, you'll have about $24,000. Not bad, right? Except inflation is going to eat most of that. In real terms, you'll have maybe the equivalent of $15,000 or $16,000 in today's dollars. Now, let's say you put that same $10,000 into an S&P 500 index fund, earning an average of 8%. which is below the historical average. In 30 years, you'll have just over $100,000. Even after accounting for inflation, that's real wealth. That's the difference between retiring broke and retiring with options. And the only difference is where you put the money. Same starting point, same time horizon, completely different outcome. Here's my point. The system is rigged, but it's rigged in a predictable way. Once you understand how it works, you can position yourself to benefit instead of getting crushed. You're not going to change the Fed. You're not going to change monetary policy, but you can change your behavior. You can stop treating cash like it's safe and start treating it like the depreciating asset it actually is. You can stop waiting for the perfect time to invest and just start, because time in the market beats timing the market every single time. Now, I know some of you are still skeptical. You're thinking, this sounds like a sales pitch, and I get it. But here's the thing. I'm not selling you anything. I'm not telling you to buy some course or subscribe to some newsletter or follow some guru. I'm telling you to open a brokerage account, buy a low-cost S&P 500 index fund, and hold it for decades. That's it. You can do that for free. You don't need me. You don't need anyone. The information is out there. The tools are available. The only question is whether you're going to act on it or keep doing what you've been doing and hope it works out. Because here's the brutal truth. Hope is not a strategy. Saving cash is not a strategy. Working hard and waiting for raises is not a strategy. Not in this environment. Not when the Fed is actively devaluing your currency to prop up asset prices. The only strategy that works is to own assets, period. And if you don't, you're going to spend the next decade watching your purchasing power erode while everyone around you gets richer. Not because they're smarter, because they understood the game. So here's what I want you to take away from this. 3 things. First, understand that the Fed is not on your side. They're not trying to help you build wealth. They're trying to stabilize the system, and that means inflating asset prices. If you're not positioned to benefit from that, you're going to get crushed. Second, stop treating cash like it's safe. Inflation is a silent tax, and it's about to get worse. If you've got money sitting in a savings account that you don't need for the next few years, you need to invest it. And third, start now. Not next month, not when the market pulls back, not when you feel more confident, now. Because every day you wait is a day you're losing to inflation. The good news is you don't need to be rich to start. You don't need a finance degree. You don't need to understand complicated strategies. You just need to understand the basics, open an account, and start putting money to work. And if you do that consistently over time, you're going to be fine. You're going to build wealth. You're going to outpace inflation. You're going to set yourself up for retirement that doesn't involve working until you're 80. But you have to start because the Fed just told you what's coming. They're opening the faucet again. And the last time they did that, the people who owned assets got rich and everyone else got left behind. Don't be everyone else.